There you go. Hey, welcome everybody to another Monday night mastermind here. And the last week and this week, we have not had any guests, but we do have a guest coming on, I think next week and the week after. So stay tuned for those. But tonight, I think I want to bring it back to multifamily fundamentals, back to the basics. A lot of people have been asking, I don't really know how to underwrite. And there are newer people coming into these calls that really don't have the fundamentals. And when I talk about multifamily, I start talking about high level stuff. There's no basis to really understand it. And so I want to make sure that tonight we do that. And I'm also going to go live on Facebook. So one sec. It's taking a minute. Okay, cool. So for those of you guys that have not been on this call, I will just introduce very quickly while other people are still hopping on of how this mastermind came about. Okay, long story short, I created freedom for myself through real estate investing in a very short time. And the formula to financial freedom is actually pretty simple. Most people have, I got to earn money and then I go spend it. The financial freedom path and to create long-term wealth is to take that active income, invest it into something that pays you, and then spend that money that comes from your investments. So that's called the passive income. Most people understand what passive income is conceptually, but until you actually have experience around it, where you just see money enter your bank account that you didn't have to do anything for, it's kind of like collecting rent, right? Without having to do anything. And that part of the equation, most people have not yet grasped. And it's not that they don't want to grasp it or they don't like conceptually get it. It's just there is a mindset shift that needs to happen where you look at, you don't value your time or energy enough. That's what it really comes down to. When people talk to me and when I have conversations about multifamily and real estate investing, okay, not buying it yourself and running it, but investing it so that you get passive income, people are like, oh, well, I can get 15% or whatever percent on cash if I just went and bought it myself. Okay, maybe there is a 8, 9, 10% difference when you run it yourself, but you're also not valuing your own time. So financial freedom comes from when you're able to get the passive income truly from it. Passive means I am doing something without the exchange of my time and money. I am creating an income without the exchange of my time and my energy. Sorry, my time and my energy, because those are important things. When you start to value those more and more, you will not want to be, you won't want to be doing it yourself. Right. So the path to financial freedom is really to create that. Now, the way that we get to that is pretty simple to get the number. If you want to have, okay, let's say if you want to have, this is most people's goals right away is $10,000 a month, passive income. That's what most benchmarks are, right? Like right off the bat. If you never had it before, I want 10,000 a month. How do you calculate that? Okay. If you look at most passive investments, you should pretty standard be able to get somewhere around 5%, right? 5% of whatever you invest. That means if you take $10,000 a month, you times 12 months, that's $120,000 you need to have in passive income. Okay. You take that number and you divide it by 5%. That means you need to have $2.4 million invested, okay, to have $120,000 a year in passive income. Now, most people get discouraged when they hear, how am I going to invest $2.4 million? Now, let's break that down a little bit. Real estate, most of the time, you can count on a 2x every 5 years. Okay, sometimes you can do it in 2 years, sometimes you can do it in 3, but passively, you should be able to get a 2x on your money every 5 years. So if that's the case, let's look at what happens if I invest $100,000 today. If I invest $100,000 today, that means in 5 years, it will be 200,000. In 10 years, it will be 400,000. In 15 years, it will be 800,000. In 20 years, it's going to be 1.6 million. Okay. In 25 years, it's going to be 3.2 million. Now we're like, damn, I got to wait 25 years. Well, people are waiting 25 years, 40 years just to get a couple $100,000. Okay. That's what your 401k and that's what your retirement plans look like. And 90% of the people in the country that work a W-2 job participate in that. Okay. You're lucky if you work 40 years and you retire with $400,000 to take out. Okay. You're lucky if that's the case. There was a statistic, and I don't know, I can't find it right now. I was looking for it right before this call, but I think about 70% of the people don't have more than $300,000 in their retirement account when they retire. Don't have. Okay. If you have $1 million or more, you're in the top 5% of people that retire with that amount of money. That means you're trading 40 years for $1 million. And that's if you're in the top 5%. So in my example, if you invest 100K in real estate, 25 years, you have $3.2 million. Okay, let's see what that number goes to if you did 40 years. 5 more years. On your 30th year, it's going to be $6.4 million. On the 35th year, it's going to be $12.8 million. On your 40th year, it's going to be $25.6 million. Wait, yeah, $25.6 million. $25.6 million in 40 years. Okay, what is that? If you invested from the start, only 100K, and that's it. You invest 100K, you leave it, you reinvest it every time it doubles. You'll have $25.6 million in 40 years. All right, so $25.6 million times that 5%, you will have a yearly passive income of $1.28 million. So along the way, we haven't been counting any of that passive income because you're going to spend it. It's okay if you're going to have passive income come in this month and you're going to go buy your Xbox, go for it. Next month, it's coming again. Okay, I think Grant might have said this, but he's like, your passive income, your drips from your investment allows you to be sustainably stupid. You can be sustainably stupid, buy a bunch of dumb things. But if you traded your time and your energy at a job, okay, whether it's a W-2, commission-based, freelancing, whatever it is that you do, okay, if you did that and then you went and bought an Xbox, you're saying that your time is valued only at the value of that Xbox. I don't know why I said Xbox. Maybe a watch, a car, whatever you spend your money on. Okay, if it isn't about reinvesting back into something, then you are wasting that money. And you're really just saying my time and that's it. My time and energy, it's not worth anything. Let me go and do it again. Let me go trade more time and more energy. Instead of having the mindset that everything is about creating passive income. Okay. And you may say, I don't have 100K. Well, you still need to have the experience of having passive income, which means go buy a stock that has dividends, right? Go write a block, go create an affiliate marketing, something that creates passive income, even if it's $5 a month. Because you'll be like, wow, I didn't work for this. Here it is. And then it becomes a game. Then you're playing the game of financial freedom. And a game is much lighter than how else we view money. Right? So that's sorry, my dog's barking. But that is the simple formula of creating financial freedom in 40 years. Now, that's $100,000 invested. Boom. That's it. Okay. So I just want you guys to look at the perspective of that. Real estate and investments have, what is that called? Compounding. There's a compounding effect that happens in investments. In the beginning, it may not look so good. Man, so you're saying I got to put 100K in to get $5,000 a year? Why the hell would I do that? Because 5 years later, it's now worth 200,000 and you have 10,000 a year, then 20, then 40, then 80, then 160. See, if you're on a mission and you know what the purpose of your active income is, that's how you start to create financial freedom. And the financial freedom isn't even the monetary value, it's a mindset that you shift into. That's financial freedom. It's the wealth that you can create. So in one generation, you can literally change the financial position of your family forever in one generation. In 40 years, what is the formula to get to 25 million in 40 years? So if you invest $100,000, every 5 years that money doubles. 25 years is 3.2 million. Then it goes to 6.4 on your 30th. Then it goes to 12.8 on your 35th. And on your 40th year, it's $25.6 million. Okay, that's pretty simple on how it works, right? Now we can get it. It's just a perception shift I want you guys to think about, because we trust blindly in 401k, mutual funds, index funds, all of that. Okay, well, that 25 million, the difference between 25 million and what you receive of 300,000, 400,000 at the end of 40 years, somebody else took all of that. There are institutions in between your money and the actual investment. And they're earning a lot of freaking money. Okay, these guys are earning a ton of money. All the guys on Wall Street, even if they just got on the sales desk, they're making a whole lot of money. How are they making so much money? Where's your money? You put the money up and they're making more money than you're making. See, if we just go down, if we did some critical thinking around what we're doing, there is no other games to play besides real estate. Okay, so this is why I have such a passion for teaching it, because I've seen it not work. I saw it not work being at Publix and seeing the elderly work as a cashier. I've seen it not work in my friends, in my family, where people did not get what was promised. And it's super sad. It's super sad that we live in the wealthiest country and everybody is like conned into this game. I was watching an interview with Robert Kiyosaki. He's like, in the 70s, okay, before the 70s, they had pensions and things like that. Then in the 70s, they needed to stimulate the economy and create, get the stock prices and all these companies up. So they created the 401k, which tells you, hey, they even have, there's tax incentives for companies to do this. So they match your investment and they put it into these companies, index funds, mutual funds, all of these things invest into these companies that you have zero control over. You have no idea what they're even doing. And we're just blindly trusting that. How did that become a thing? That's a question we should ask ourselves. If we have our own money in 401k and IRA, we should ask ourselves why we have it there. Like, who told me it was a good idea, and where did I not create, where did I not do the research or the due diligence around it? So and the fees that they take. Tony Robbins has a book called the Mastering the Money or the Power of Money, something like that. And he says it in there. Every percent that they take in fees from you, okay, when you have your money invested in a fund or with a financial advisor or something, every percent that they take equates to 20% of your profits. So there's people paying 3% in fees. That's 60% of your profits. And then there's tax, and then there's penalties if you try to take it out early. There's all sorts of things that keeps your money in that place. Why are we playing that game? So I have a passion to teach this. Very quickly, I was able to create this. And now I'm going to talk to you guys about how to accelerate that, because you have 100K invested as a passive investor. Great. But how do you accelerate the real estate game? By also actively participating in a way that gives you equity and stake in the deal. So instead of investing money, you're investing your time and your energy for an asset, which is basically still investments. Okay. Instead of investing money, instead of going to work my job and then getting the money from there and then putting into a deal, I can work the deal directly and get my share in there. Right. That's the game that we're playing here. It's the multifamily syndication game. All right. So, and at any point, feel free, guys, to kind of jump in, and if there's things that I'm unclear about. Right. Today, I actually had a call with somebody who was a pure beginner, and I used them as guinea pigs to create a course that will take people from the very beginning. And it really starts, why real estate? Why real estate over stocks? Why real estate over gold? Why real estate over all these things? Because real estate, now compare this to everything else. So real estate, one, protects your capital. Okay. Over the period of time, over the test of time, from the beginning of time, whoever owned land were the wealthy. Whoever owned real estate were the wealthy. Even back in the day when there were kings and barons and all that, whoever had land, they were the wealthy ones. And that value of the land continues to grow all the time. And it grows because it's a hedge against inflation. If more money is printed and money becomes, and your $100 is worth 80 and it's worth 70, it's worth 60 over a period of time, that means rent will go up. If rent goes up, the value of your property goes up. Does that make sense? If you can get more rent out of a property, you will pay more for that property. That's how it works. It's not about buying your own home, but the value of your property will be based on that. How much can it actually produce? So, second thing, it produces cash flow. Okay. Does the investment that the investment that you got going protect your capital, one, okay, or provides cash flow? If we leave it in the bank, okay, for protecting the cash flow and inflation, here's how you know. They say inflation's about what, like 4 or 5%, but it's probably not that. If you just look at gas prices, I'll look at 20 years ago when I first started driving, gas prices were 95 cents a gallon. 20 years ago. Today, I see them somewhere around $5, okay, where I'm at in Vegas. That means from $1 to $5 is a 500% increase in price in 20 years. That means every year, the price of gas has gone up by 25%. Now, rents, obviously not as drastic, but in 2021, Miami rents went up 25%. So as rents go up, the property value goes up. More about the what? The IUL life policy? Oh, like your life insurance, like whole life and universal life. You can do that. I mean, it's just another way to basically tell your, if you have no discipline with your money, put it somewhere where you can't touch it. This insurance, the whole life and universal insurance, great. It's probably a good place. The difference that you make, there is a difference, but if you're making active investments in real estate and you're doing more deals, you want access to all your capital. You don't need somebody else to babysit your money, because you put $100,000, $60,000 into a whole life insurance. Maybe the first year you can access 90% of it. Okay. Or if you're lucky, I don't know. There's different terms for different types of things. That means you can borrow against that money. Okay. Let's say you borrow it at 4%. They say that even though you borrow it, your principal in there still continues to grow 5%. It is a good strategy. It is called the infinite banking strategy, which is a good strategy. But I don't really want somebody to tell me what to do with my money. I'm not that concerned over 4%, 5%. Right. So if inflation, let's just give them the benefit of the doubt, what they say is 5%, which is not. Okay, we just looked at the gas price example. It is not. Milk, eggs, water, you can take anything that's out there that you're buying. It is not 5% increase a year. Okay, I don't know if even McDonald's Happy Meals are going 5% a year. It's probably increasing a lot more. So from that perspective, your goal for your investment is to beat 5% a year. If you leave it in the bank and you're like, ooh, if I just leave it here, it's going to be safe. First of all, I don't even know if it's safe. Look at all the things happening with the banks. Now, I don't think anything's going to happen with anybody's money. I think this is a whole a movie drama or story or a scheme for the big banks to eat the little banks so that we can become more monopolized in that place too. So that's just my own opinion. Don't weigh on that how you will. The sky's not falling. Okay. So you got to beat that. You got to beat 4%, beat 5%. Now, real estate, like I said, if you double every 5 years, that's about a 20% return. Okay. It's your cash flow, which might be 5%, and your appreciation plus your tax write-offs, these types of, that doesn't even include the tax write-offs. I won't even go there yet. About 17 to 20%. You're beating inflation. Okay. And then you also get all the write-offs. You can own real estate, and from the time that you own it all the way to the time that you sell it, you can actually never, ever pay taxes. You can either write it off through depreciation, or you can defer the taxes down the road with something called a 1031 exchange. I won't go super in depth on each one of those things, but just know that the tax write-offs that you get, the tax incentives you get in real estate is greater than anywhere else that you can put your money, any other investments. Also, other people's money. You use other people's money in real estate, and it may not have to be your sister or your mom or your friend's money, the bank's money. Okay, you put 20 to 40% down and you get a loan of 60 to 80%. You're using the bank's money to make money. They'll give it to you today at 6 or 7% interest rate, but at 6 or 7% interest rate, and you're still making 17 to 20% on your real estate, you're making 12 to 13% or 11 to 13% on the bank's money, not even your own. Where else can you get a loan like that to do that for? Right? Maybe a small business, maybe some sort of business loan, but that has way higher risk. It's no longer really like an investment, unless you're buying like a franchise, something like that. Different story. But real estate itself allows you to use other people's money. So that's real estate. And if you compare it to all the other different investment vehicles that you can go into, Bitcoins, stocks, gold, commodities, I don't know, all sorts of stuff. You don't have that. You're missing either tax write-offs, or you're missing cash flow, or you're missing leverage using the bank's money, or you're missing that it actually is almost a guarantee to protect your capital if you don't get over leverage and you run it correctly. If you can stand in real estate for 5 to 10 years, you will most likely be very happy with the outcome that you're going to get. Real estate moves in cycles. Every 5 to 10 years, there's a point in which you should not be selling real estate. Like today is probably, I wouldn't say it's at its lowest, but maybe 2008, 2007, that would be a time not to sell your real estate. But if you kept it and you made it through there, now real estate is way higher than what it was even at the peak of 2007, 2008. Right? It goes through its cycles, but it always goes up. And then there will be a time where people will overpay like crazy, where rents go up 25% in 1 year, and you can take advantage of that. You go and you increase your rents, and then you go to the bank and say, look, my rents are like this. Let me get a new evaluation on my property and let me take out money against it. Boom. Or let me sell it at this time, because people will overpay. Interest rates being super low, that means your value of your property, people will be able to afford more of it. Okay, if interest rates were at 8%, people can only afford so much with their income. with their debt to income ratio. If it was down to 4% or 3%, now they can buy a much more expensive property. And then that's the time to sell your real estate. So it goes through those cycles, and you will just, if you wait long enough, you will know, oh, here's a good time to sell. You don't always have to catch the top or the bottom. You can buy real estate in any of those cycles, and it will be higher in 5 to 10 years. And that's the beauty of real estate. So if anybody at least if you get nothing out of this call and you leave saying, okay, I need to start my learning, or I need to get involved and really get myself in a place to start investing in real estate. Good. Start doing that. This call is a great place to begin. You have access to me. You can ask questions that, where are you stuck on? You can type it in the chat. You can unmute yourself and ask me. Yeah. Cool. No worries. Just this replay will be available. All the banks have poor balance sheets. If you look at every bank, all of their balance sheets are pretty poor, because they can leverage every dollar fractional lending. They can take your dollar and lend that $1 out 10 times. How can they even have a good balance sheet doing that? Imagine we were allowed to do that. Why is it that they don't allow us to do it? It's because it's dumb. Unless you can keep printing money, that is a stupid strategy. So they know, these big banks know they're too big to fail. There's a movie out called Too Big to Fail. Watch it. It's pretty good. Okay, I'll take a breather here. Any questions, any thoughts about real estate? Okay. Let's move on to why multifamily real estate, or multi-units, and not your single family, your residential duplex, quadplex, all of that. Because people want to do it. They're like, I just want to, my barber today, I just want to own a fourplex. That is my dream. All right, cool. It's because that is how our economy and our society has beat us to our knees so much. And we all have stories of people being beaten to their knees, that we will settle for like crumbs of things. We will settle for just, if I can just own my house outright, boom. Do you have a past video going in depth for underwriting? Yeah, I do. There's plenty of videos that I've done. If you, maybe I'll have to fish it out, because my underwriting call not always has that. Some do. But maybe on the next time that I don't have a guest on this call, I can go through that. Or on Thursdays when I have my underwriting calls, we can go through deals. So Nick, send me a deal that you want me to underwrite. Okay, go look it up. Go find the deal. Get the T12, the trailing 12, the 12-year balance, or the P&L for the last 12 months. Okay, get the financials from the broker. Get the rent rolls. Submit it to me. Send it to me. You have my email. And on Thursdays, we can underwrite one or two of those deals in depth. Okay, I want this call to be more for the beginner level. There are people that come from Instagram, Facebook, people that don't have any idea what we're talking about here. All right, so multifamily, okay? Multifamily is more scalable. Okay, I've owned single families, and I know a lot of people that has. When you get to about 8 to 10, it becomes your full-time job. Full-time. There is no rest. Okay. When you go to sleep at night, you're still working. You may get a phone call at 2 a.m. that something happened. There's domestic disturbance. Okay. We got a call in the middle of the night. Oh my God, the neighbors, there's something happening. I don't know if we should call the cops. There's literally yelling. The girl is screaming, you're hurting me, whatever. Get a phone call for that. All right. That's our single family stuff. I had a phone call once that the SWAT team from my neighbor, that the SWAT team is about to break into my house, break into our property that somebody else was renting. And they busted it down. They destroyed the house, the cops. Okay. They destroyed everything, and they found like 50 grams of weed. Any good online schools or platforms you recommend in terms of what? Real estate? So it's scalable. Okay. Yes. So stay on these calls. I'm going to be doing like a 15-day challenge in the very near future. That probably next week I'll release a 15-day challenge that will get you started. Okay. And then I'll have ongoing teachings of this. But I would go to YouTube and start and do it on a shotgun type of like style. Look at everybody. Look at Grant Cardone. Look at Robert Kiyosaki. Look at Chris Crone. Look on Bigger Pockets podcast and just see who you resonate with, because everybody's got something that's working for them. Okay, in terms of real estate, learn the different things. It's like pieces of the puzzle that you need to put together. Okay, the puzzle is really big. Okay, let's say the puzzle is this, and you find the bird method. Okay, boom. You find the flip, you find the debt, you find multifamily, you find different things. They're all different parts of the puzzle that you can use this strategy and interchangeably with all real estate deals. Seller financing. Maybe you follow Pace Morby and you'll find seller financing. How do I find seller financing? You can also do that, right? Like put all the pieces of the puzzle together. The pieces that you're missing, come on to these calls and ask these types of calls. There's a lot of these calls going on now. Okay, so great. But find the person that you resonate with so that you can be open enough to listen. That's really important. I can't listen to Dave Ramsey. Okay, if I listen to Dave Ramsey, I can't hear anything he's saying, even if there was something valuable, because I'm just so against a lot of the philosophies. So I'm not going to listen to Dave Ramsey. Okay. But, Robert Kiyosaki, Grant Cardone, these guys, they may have ideas that are very similar to Dave Ramsey. Okay. Not really Grant and Dave, but there may be something that's similar, but I can hear it because I am open to what Grant has to say. So it's important to start with the shotgun approach and then as quick as you can, narrow it down. Okay. Turn it into a sniper rifle and find the exact teacher and the person that you're going to learn from and learn everything that you can. Okay. The other advice that I actually did a short video on the other day, maybe yesterday or the day before on my Instagram, was how do you scale? How do you create financial freedom quicker? And it's about finding a mentor that's not a million miles ahead of you, right? If you find Grant Cardone and you want him to be your mentor, it's going to be a lot harder for you to do what he's doing than somebody that's closer to where you are. Somebody that you can be like, that's my stepping stone. Let me get there and learn from that person until you don't have nothing to learn from them anymore. And then you go and find your next mentor. Okay. The purpose of a mentor, the purpose of me mentoring people also is to scale myself. Like I'm always like, I will not be somebody's ceiling. If I'm mentoring somebody, I will not be their ceiling. And the only way I cannot be their ceiling is I continue to look for mentors myself. I be in rooms that you guys are not in so I can bring the information back to everybody. Okay. And that's how the game works. You don't want to skip. You don't want to skip and go to Grant because the resources he has, the knowledge he has, you don't got it. And if you don't got it, how do you play the game? You can learn from him, but you can't play the game he's playing. Nobody can. We're all in his real estate club and nobody is partners with Grant. Now, there's a couple people that have found niches. Okay, Brandon Dawson, how to take your company, how do you grow your company, how to scale your company? Grant's like, yeah, I like that. Partnered, boom. Okay, Pete Vargas, hey, your people need to learn how to speak. How can I offer things to your audience? See, that works for Grant. But if you're like, hey, Grant, let's do a real estate deal together, he's going to be like, what you got? You can't even talk about the things that he wants to hear. That's the gap. The gap is too big. So you got to find that. Okay, back to multifamily. Multifamily is also, believe it or not, on the debt side, easier to acquire than your single family house. Okay, because your single family, they're going to ask for your credit score. They're going to ask to see your debt to income ratio. And in our society today, debt and income ratio is jacked up. People are in way too much debt and too little income to even be able to buy the house that they want. So they end up settling, and getting a smaller house and then getting themselves into bigger debt, and then they're stuck, right? A lot of us can probably relate to something like that. We bought our own home and then we're like, shit, I can't buy a second one because my debt to income is jacked up now. I bought a home that cost me $1,200, $1,500, $3,000 a month. Now I need to make an extra $6,000 a month just to be able to qualify for a loan. Okay, who's doing a $72,000 increase on their W-2 job in 1 year? Unless now you're like, shit, I gotta go find another job. I'm gonna go ask for a promotion. I make $100,000. Who's gonna give you a 72% increase on your yearly income? So this is why everybody is so stuck. But no matter where you are, if you guys have ever played Robert Kiyosaki's cash flow board game, start to play that, because you can start as a janitor or you can start as somebody making a crazy amount of money, and you are all in the same place. It's just what you do with your money. And everybody can break free from the rat race. I was watching this show called Ballers. If you guys have not seen Ballers, okay, it's pretty interesting. It's The Rock. He's trying to become the financial manager for a lot of these professional athletes, football players. And these football players, the way they spend money is exactly what all professional athletes do, most. Before they even get their big contract, okay, they're about to sign $30 million a year, something like that. They've already spent $5 million, $6 million, hoping to pay off what they're going to make with their next check. They can make $30 million a year and be living paycheck to paycheck. And these agencies and these financial advisors for these professional athletes, they prey on them. They're like, yeah, sure, of course, you're gonna have this big contract. I'll lend you the money right now. We'll lend you $500K. We'll lend you $1 million. It's very easy for them to borrow money wherever they want to spend it because they got this big check coming. And it causes them to go buy big houses right away before they even get their first check. They've bought their mom a house. They bought themselves a house. All of their friends are hanging out at their house. They've bought like 5 supercars already. And what else they spend their money on? It's just blown away. And it's no different than how the average Joe spends their money. I get my check coming in the next month. I'm going to get a $3,000 check. I have a bonus coming, and I'm going to go buy the things I need to buy now. I'll put it on my credit card and I'll pay it off with my next check. All right. I asked my barber today this, and it kind of changed his mind. I was like, you go to the casino, okay? Just play along with me. You hit the jackpot on the slot that says $25,000. What are your first thoughts? And he starts going right into making my point, right into the things he wanted to buy that he can't afford right now. He's like, I really want to get a nice watch. Okay. I've always wanted a really nice watch. It went on and talked about the watch, talked about some nice things that he really wanted to buy. I'm like, this is the trap right here, man. I'm like, your mindset's messed up. And all of us had that at some point. All of us still have it. I still have it. But like, can you create the discipline? Can you set yourself up to win? Right? Like my wife and I are in the process of creating this automatic distribution of money into my personal account. Okay. Some money goes here. 10% is going to go straight to charity. Like it's going to be set up in a way that I'm not stupid with it. Right? Like as much as we get on our passive income, things like that, it doesn't cover my lifestyle, my expenses. Okay. Just my marketing alone for my social media and the marketing company and all that, I'm spending like $9,000 a month. It's a lot. Okay. But I have editors. I have people. Now I got somebody flying in from San Diego every week to take my YouTube channel to the next level. Okay, that's $3,000 just for all of that a month, not including whatever else I got to spend for him to come here. Right. And then going to these conferences. These conferences, I'm always like, this is the best investment that you can make. It might cost a couple $1,000s to go to a conference, stay, rent a car, eat junk food while you're there, because it's just terrible. When you go to a conference, you always eat like shit. Or that's just me. Sorry, that's just me projecting. Okay, back to multifamily. I don't know where I got off track here. It's less risky also. More units means less risk. If you have one house, okay, that costs you $2,700 a month in mortgage, you can get $3,000 a month in income. Okay, there's so many people live like this and they think they have a great investment here. You make $300. Let's just even say $400. You make $400 a month. All right. That's $4,800 for the year on your property. And they're like, yeah, I got to do it myself. I can make this. I don't have a management company because they can't afford one. All right. I make $400 a month, $4,800 a year. It costs you $2,700 a month. You have 2 vacancies, 2 months. If it's not rented out for 2 months, or you have a problem collecting rent or something, it's going to cost you out of pocket more than what you would make in a month, in a year with that property. Risky as hell if you think about it. But if you have more doors, if you have 100 units and 1 unit becomes vacant, you have a 1% vacancy. You can survive and you can still pay for all your stuff. If you got 1 unit, 4 units, you can't afford to have 1 person leave your property. Now you're at the mercy of tenants. So you got to pick up phone calls at 2 in the morning because you got to be a good landlord. See the difference right now between residential and multifamily? All right, so scalability, easier to acquire the debt because they look at the property itself, okay? And you can bring partners on. Somebody else can sign on to the loan. All right, all these different things. So more units, less risk. So it's always less risky. Now, the mindset that you have to have, and this is what I just shared with the teens earlier, because we were actually talking about partnerships. It naturally went there. You want to be, okay, if you had $1 million and you can buy a property right now, you don't want 100% of one property. All right. Now, if we're being honest, probably more than 50% of the people in this room is probably like, I want to own this outright myself. I want to collect all the money myself. You rather have 1% of a $100 million deal or portfolio. Okay. The money, the monetary value is the same, but being involved in the deal that size has less risk. Okay. You have a real management company managing it. All right. And the opportunities that open up from being in a deal of that size and that magnitude will definitely return you more than that $1 million just in opportunities and relationships created alone. So that's why multifamily. Okay. Okay. Let me go a little bit deeper into any questions so far. Questions or thoughts about real estate? I'm trying to bring it like really basic this time, you know, just so we can at least get on the same page. All right, I'm going to show you guys something. This is what I created. It's the magic math of multifamily. Hang on. So this is part of this course that I'm creating right now, but I'll show you one page of it. And it's not very pretty right now. Somebody will make it pretty. All right, the incredible math of multifamily, which you got to understand, is the cap rates. Cap rate is how much money you would get in return if you paid all cash. So let's just whatever cash you pay. So if you make $100,000 in your net income, and the property was $1 million, and you bought it all cash, you would have a 10 cap on that property. All right, so let's just kind of go into this. I know it's going to generate some questions here. So you got to first understand NOI. What is net operating income? Net operating income is your total revenue minus your operating expenses, not including the debt. So we're going to use an example of a 30-unit apartment building that you would buy. You have $200,000 in rent income, You also have coin or credit card or whatever operating laundry machines. You make 10,000 a year in that. So this is all in yearly numbers. Okay. We want to look at real estate in yearly. Then $5,000 for your nice parking spots, the ones that are closer to the building, whatever. Your total revenue for your property is $215,000. Okay. Total revenue. Your operating expenses. You have a management company that charges $10,000, usually about 5% of your total income. $10,000 for management. Property taxes on this property, because it's in freaking Florida or wherever, it's $50,000. Your insurance is $15,000, and you got miscellaneous expense $6,000. It could be whatever. There could be other ones on here. It's example. So you have an operating expense of $81,000. Your net operating income is $215,000 minus the $81,000. That's $134,000. Now let's understand cap rates. Cap rates equals the way you get cap rate is value. Okay, the price of the property equals the net operating income divided by the cap rate. That means if you have two of the numbers, you can figure out what the third number is. With me here? If you just had the value and the NOI, you can figure out the cap rate. If you just had the NOI and the market cap rate, you can figure out the value. If you just had the value and the cap rate, you can figure out the NOI. Okay. Current value that they're trying to sell is $4 million. If you have $134,000 in NOI, right? Value equals NOI divided by cap rate, but you don't have the cap rate. So you take your NOI and you divide it by the value to get the cap rate, which says the cap rate is, if you take take your calculator and do 134,000 divided by 4 million, it's a 0.0335, which is a 3.35%. Hold on. Now if you're like, I don't really know what to buy, how much the purchase price is. Okay. They're just like, you make an offer. So you're like, all right, same property. It's got $134,000 in NOI. I want to buy it at a 5 cap because I need it to be somewhere close to my interest rate. So my interest rate on this deal might be, I don't know, I'm assuming a 5% cap, 5% interest rate deal. So I can pay, you take your 134,000 NOI divided by the 5 cap that you want, which is 0.05. You're going to pay $2.68 million for this deal. And you can tell the seller, like, look, I would love to pay $4 million, but the bank doesn't let me because the cap rate's too low and I can't get that money. So now you're getting it. Now they're like, okay, fine, 2.68 million. So you do it. Now, pro tip is if your cap rate is greater than your interest rate, you will most likely be cash flow positive. If your cap rate is less than the interest rate, you will most likely be cash flow negative. For example, if you take 5% interest on $2.68 million, which is the same thing as the cap rate that you got at 5, your yearly interest only payment is $134,000. Now you're break even, right? Your NOI is 134, your debt is 134. That doesn't include the principal, which you may have to pay if you don't have interest only. Questions before we move on to the incredible math? Okay. If you take the same 5% cap rate on the 30 unit property valued at $2.68 million with 134,000 NOI, and you can increase the NOI. You increase the net operating income by either raising the income or lowering the expenses. Okay. I would focus on increasing the income. You can lower expenses as well, but sometimes that hurts the quality of the asset and you may not be able to increase because you cut some expenses. All right. So let's just say we can increase the rents from each unit by $250. The expenses stay the same. You increase the rents by $250. $250 times your 30 units times 12 months gives you $90,000 increase in net operating income. So expenses stay the same. Everything stayed the same. You've just increased the property income by $90,000. If we take, remember, the value, right, equals the increase in value is the NOI divided by the cap rate. Your new increased NOI is 90,000. You divide it by that same 5 cap, you have a $1.8 million increase in value in the property. Which means if you take $1.8 million and you divide that into the 90,000 you increase, every dollar that you increased is equivalent to $20 in value. Where else can you put $1 into something and get $20 back? That's why multifamily and multi-units is greater than, I would say, any other investments out there. Okay, that includes single family and residential real estate. Okay, it's not based on market comps. It's not what Joe sold his house down the street for. It's literally, can you increase the income of a property? Is it below market rents? Can you put in new appliances and increase the value, increase the income? All right, there's got to be some questions here. Is higher units less risk because of the diversifying investment? Also, will investors consider Class B if they're more prone to investing A? Okay. Or C if they're investing in B or A. Okay. A class asset means the quality of the property is better, and it's probably also in a better location. So location and the age of the building or the quality of the building. What's happening? Who's doing that? All right, I'll stop share. That's funny. Who can draw on my screen? That's interesting. Well, thank you very much for that. What else? Let me also just make sure I stop from anybody from sharing screen in case somebody wants to play games. So yes, to divide more units, okay? More units could be better because it's not because they're diversifying investments. It's just because you have less risk when people vacate the property. Okay. People would consider Class A versus Class B, Class C, because Class A is wealth preservation. You're preserving your wealth in Class A. It has better, it probably will appreciate higher. You have less problems with your tenants. The quality of tenants in there will be higher class. They will make more money. If you increase the units by $100, nobody's going to say anything. Now you go to a Class C, you increase the units by $100, they might just move out, right? Because $100, it's a big difference. So that's what you got to consider. And usually Class B or Class C type of properties will produce more cash flow, but it's also more unpredictable because anything can happen in those properties. You will have more delinquencies. You will have problems with tenants. You will have more people move in and more move out. So the turnover cost, okay, turnover is going to be your highest expense in real estate. You will have more of that in a Class C. Class A, you have less of. So that's what, the difference. Now, depending on how much cash flow you have, because you invest in the Class A, most likely you will have to wait many years for a 5, 6, 7% passive income on your investment. Okay, because they buy it at a very high rate, high value, high price, because that's how much they go for, and you have less of passive income, cash flow from it. And then, you hold it for a while until you can increase the rents. Class C types of deals, most likely you can go in there and have positive cash flow day one, but their delinquent balance sheet will also be much higher. So you have your office buildings count as multi-unit if you have a lot of units, but I would be careful going into office buildings right now, because who really is renting office buildings? I don't know. I think we want to let that settle out a little bit. There is a lot of units coming due and that are in trouble, that are, majority of them are office buildings, office spaces. Okay, they're in the most trouble. Now they're categorized into commercial real estate, So it kind of makes multifamily apartments and stuff like people get confused and mix them up. Like, ooh, look at the risk here, right? But and then you see some delinquencies, you see some foreclosures, things like that going into the office space that people got to sell for cheaper. You just got to do your due diligence. Like, okay, it's not the multifamily space because most of the multifamily deals that I've seen, nobody is lowering their price. Okay, that's why nobody can buy any deals right now because nobody's buying it. You got to really work it. You got to really find the diamond right now. But that doesn't mean you can't find it and doesn't mean you shouldn't be finding it.
Fuck you, bro. Fucking Chinese. Fuck you, bitch.
Okay, wait. Why is this under? He's under JJ Miles. All right, let's remove JJ. It's you. Funny. Okay. Um, they they made your name in there. Come on, JJ. Why are you bombing? Why are you bombing and sabotaging my Zoom? All right. Well, you'll always get people like that really they should be investing more of their time in learning rather than doing shit like that. Cause what really that's I don't even know what fun do you get out of that, right? That's the question. What's the payoff? There's no payoff. I don't know. Yeah. Okay, so any other questions? Because I do want to give us the time to also network with each other. And we can kind of just open it up and let's have a more of a conversation at this point. And then I'll continue this conversation next week if Zasha doesn't make it to that. And we'll talk about how to become an active participant in the multifamily space. Because we all know to invest, you get passive. How to be active and what does that look like? What does the table look like? What are the different types of ways to acquire a deal? And yeah. Any thoughts? Also, I do believe that increasing your active income is really important. Okay, people kind of discount that a lot and they're like, let me just go straight to the passive. But increasing the active is super important. Now, I've recently had people that, are in the hotel business, things like that come onto this call. And, it's just how active do you want to be? It seems like there was a lot of work that went into the hotels. And I'm not against it. Active income is cool. And if I have a partner that does the active side of it, awesome. That's why real estate and multifamily is great because you just find partners to do things. All right. Well, where else are you guys challenged in terms of multifamily? If everybody is not doing multifamily already, you should have questions. For single family homes, 30-year convention is the norm. What about multi-units? Yeah. So multifamily, 10 years is considered a long-term debt to get on a deal. And, it's 30-year amortized, but I don't know anybody that even holds their single family home loans for 30 years. Okay. There's every so often a refi happens or something happens. So, I don't know why, if you plan on paying off your property, you're going to have a lot of opportunity costs. And B, you will, you might as well pay it off earlier. There's strategies to pay where you can pay off earlier and pay less interest. Okay, so you can save yourself some money doing that too. Do I have any workshops coming soon? Yeah, starting next week, I will be launching the 15-day challenge. So everybody check your emails if you're a part of it. Yeah. So the 15-day challenge will come. In the 15-day challenge, you will learn what parts of real estate you want to be a part of, what you like to do. Okay. You'll also know where you are. That's the first part of the map bye, Kathy, is to get yourself to figure out where you are on the map. Right. Like if you go to the mall and you look at one of those things and you're trying to find the store, if you don't know where you are, how are you going to get there? So that first challenge is going to be that. And then we'll move into deeper and deeper parts of the process. All right. Okay. Who else wants to do multifamily, but where are you stuck?
Hey, Alex, Matt Strayer.
Hey, what's up, Matt?
Man, we've just been stuck with debt lately. Like the trouble getting debt that will work with the deals.
Mm-hmm. So give me an example.
Well, we had a deal south of Oklahoma City. Occupancy was like 85%, and the P&L wasn't super strong because the owner's filing bankruptcy. And so, of course, the debt that we get quoted is bridge debt because none of the long-term like Fannie Freddie agency stuff will work.
Yeah.
Of course, that bridge debt's like 11 or 12%, for 2 years or something, but it completely screws the
Yeah.
final one. It's
I
great.
would
So
look here is so there's pros and cons to it. The cons is that it's going to be harder for you to find a deal. Okay, find the right deal. But if you could find a deal that could cash flow at 11 or 12%, think about how money this property is going to be without doing anything. If you refied into a 5%, 4% loan in the years to come, then this property is going to gain that much in value just by having having something that runs at that number. Right. So it's not really a debt problem right now. It's just about finding the right deal and the right buyer or the right seller.
Mm-hmm.
Yeah.
Which I think it could be stabilized within the year, because it was poor management and the dude, just stopped paying attention to it.
Yeah, I would. So for poor management, okay, a lot of people use that as the reason why a deal doesn't work. Okay, poor management, I would use that as like the fourth reason why you would buy the deal, right? Like, because you're basically saying we can manage it better. Okay, that's why we're gonna come in and make sense of this deal. But is there three other things before that makes you want to buy the deal? That's what I would really say to a lot of people that says poor management, right? Like we saw a deal recently that they're operating at 60 something percent expenses. We're like, yeah, obviously this is poor management, but we're not using that as the reason that we're buying the deal.
Right.
Yeah.
I mean, it's more like, it's kind of fallen to a C-class property, but it's literally they just developed a center right across, like walking right across the street with Starbucks and Target, and
yeah, so the location's good
anchor spot. So goofy stuff like the owner has 15 units down for the AC not working, and they said they could put completely new these. It's kind of like a motel window unit looking thing for the AC, but $1,500 for new units. So it'd be $20,000 to get 15 units up and going. It's $600 or $700 a month.
Yeah, you don't need to pay $1,500 a unit for those things.
Pizza.
But just even if we did for $20,000, you'd have 15 units up. Occupancy would be right, and that would increase the valuation at a 7 cap by like over $1 million.
Mm-hmm. So what would the seller consider any other options besides just selling it outright at that number?
Well, it got put into it's covered by the trustees, like a board of trustees, because it's in bankruptcy court right now.
Oh, right.
So he can't do any like creative financing because the court took it. Like he's still the owner, but they're making the decisions, I guess.
Yeah. Well, I would go to the bank and see what you can work out with the bank.
Mm-hmm.
You know, they might give you something to, if there's a will, there's a way. It's about
Sure.
being super creative, you know, like not stopping when the first no comes,
Mm-hmm.
you know, when the first time it doesn't work out.
Right. Right.
Because if you're having a problem with it, the bank doesn't want to own it. The bank does not want to operate that deal. You know, so yes, they're taking it back, but they're looking to flip it.
Yeah, for sure.
Yeah. So you may even want to do some research on the property, look at the loan that's in place. Like, how much do they owe? What are they being foreclosed on? You know, because maybe you meet the right person in the bank that can say yes to something. And you're like, all right, why don't I pay off the loan and take this property? And the bank's like, yeah, okay, take it. Right. Let me just pay off this loan and get the property.
Mm-hmm.
You might find that you get a huge discount on it. And if you get a big enough discount, then you can justify 11-12% on your interest rate. You know, you can raise more capital to cover some carrying cost as well.
Right.
Now you'll have to find the investors that have that type of appetite, that's willing to be like, yeah, we'll get in on this deal. We love the value of it. You just have to tell a great story.
For sure.
Yeah. So that's awesome. Anybody else? I mean, so you're in the multifamily space, so that's great. You know, and real estate is not really multifamily is not really any different than everything else that's out there. You know, all the other real estate, like the process is basically the same, just with more units, right? The process is all kind of the same. Actually, kind of easier with multi units. All right, who else? Feel free to comment if you're also on Facebook that you want to ask any questions, because I do see the comments on there. I see people are on there right now. Or join the Zoom and ask the questions live. Who else is in real estate, wants to get into multifamily, and are challenged by something? I don't have the money. I don't have the network. I don't know how to find a deal. I don't know how to underwrite a deal. I'll help you guys out with some prompts. All right. Well, only 2 more minutes. So I need more help finding deals. Okay, great. So part of that 15-day challenge I'm going to be doing is also going to give you the steps to calling a broker, to finding the right broker, to identifying your market, to a script that gets you started on the conversations you will have with a broker. It will also give you some things to talk about in terms of capital raising, right? You want to have, before you move on from the 15-day challenge, you want to have the knowledge to do the deal, to find a deal. And then you also want to have the knowledge of how much money can I bring, or what's my net worth? Where's my place? What's my role in this game? And then also, how much capital do I think I can raise? All right. So during that process, there will be prompts of what to post on your social media as well for those 15 days. You know, the worst thing, I don't know if this is the worst thing. The worst thing is not doing anything at all. But I see people that are just getting into the multifamily game and they want to look really professional and really good already. But you can't, because you're not. So then you're just, you know, going into it with like, what's that? The imposter syndrome. And then you got to deal with that, and you make it harder on yourself. Right? So instead of posting something like, hey, you know, we got great investment deals in this market and why real estate is great and all that, but if you haven't done it, what's all that about? You know, people are going to ask you questions and they'll find out that it's worse to come off a certain way and be found out that you're not that, than to be more authentic and genuine. So part of the 15-day challenge is also about very genuine of where you're at. Hey, I started this challenge. I'm looking at this market, Savannah, Georgia. Does anybody have any feedback about this market? Does anybody have any feedback about why multifamily? And now you get participation. You get engagement with people by being real. And then by day 15, you should have had multiple conversations with people. And those are the types of prompts that the 15-day challenge will bring for people. Okay, I'm actually going to do it with everybody when I launch it. And it's going to be pretty cool. Now, if you aren't part of our Facebook group, Andrea and Roberto, they have a little QR code right there that you can also just scan with your phone and be a part of that community. Yeah. And here's the other thing. Jake just said, I met a very successful CEO on this last trip, but I don't even know how to leverage that relationship. That is everybody's problem. Because you don't have something great, when you meet somebody awesome, you don't even know how they can help you. Right? You're just like, man, this guy is awesome. He's the CEO. He's got hundreds of millions of dollars. He's got reach. He's got, the perfect thing for if you just had something. That's the sad part sometimes about when we don't have something to offer. If we just work our W-2 jobs, hey man, yeah, I'm in this. This is the field I'm in. I sell medical supplies or whatever. I sell, whatever people sell these days. I can't even name a W-2 job right now. Crap. I'm so out of touch with it. I don't know. I'm a cyber security person. That's as far as I can go with W-2. Okay, so we will take this time to if we don't have any more questions, we'll just break out, make one or two of these rooms where just have a conversation with people that's in your room. Okay, and just simply connect, and you never know where these relationships will get to. Even if it's people that you've met already, people that you know on these calls. There is more ability to do it. Everybody's like, "Oh my god, I don't want to talk to anyone." Okay, then next time. Let's see. Nick. Make co-host. How do I approach people without like you won't bring as much value to the group? Okay, don't send everybody. Yeah, I want to answer this question. Be curious about what they do. And then take notes. Okay, this is the CRM that you got into, is going to give you the ability to take notes of everyone that you meet. Be super curious about them. What do they do for a living? What's their favorite sport? What do they like to do? Do they like golfing? Do they have kids? Do they like dogs? Like, go deep with people of like what it is that they're doing. You want to be curious, and then you figure out, how do I bring value to this person? Good question. All right, Nick. Ready to send everybody. Break it out into like 5 people per room, because some people probably won't go. I don't want anyone to end up with nobody.
That.
So
They're open.
yeah, off you guys go. And we can probably stop the recording at this point.
Bye, guys.